let's talk about both sides of it, GC. At the end of the day, we're all rooting for the soft landing.
Right.
Let's say it happens. Let's say we figured it out, was one of the like 1 in 20 that you actually hit a home run with the bases loaded. What does that mean for real estate investors if we actually get to this soft landing?
Well, I think for real estate investors, whether it's soft landing or recession, we are in a position of strength.
Okay.
Because regardless of what you think, soft landing or recession, we are all expecting interest rates to go down at some point in 2024. That's what the Fed is signaling right now. That's what the overall market is expecting. And if it doesn't happen in 2024, it's 2025. But at some point, we know that the Fed's interest rates right now are higher than they want. And as real estate investors, when you know that rates are going to come down, meaning the Fed funds rate is going to come down, that has an indirect effect on your mortgage rates. And the greatest indication of increased home prices is actually falling interest rates. When interest rates go down, mortgage applications spike up. That's one of the reasons that you had multiple offers on your house.
That had been on sale for 6 months.
It's been on sale for 6 months. Rates went down. You locked it up, and you had to fend off multiple offers.
To fight somebody for it.
Okay.
To the death.
And you fought them to the death. Way to go.
Yeah.
Think about that across the entire economy, because that's what's really happening. And then there's more demand that's created, and home prices go up. So this is one of the reasons that this asset is so resilient, even in bad times. And what I have been sharing and shouting from the rooftops is that buy your properties before rates go down so that you can take advantage of the appreciation that will result from it. And oh, by the way, you still end up with the same low rate because you just refinance down the line. So regardless of soft landing or recession, I think we're in a position of strength. I think a soft landing would be maybe better for real estate. Honestly,
higher home price appreciation, probably.
Well, honestly, it's a factor of rates coming down.
Okay. Yeah.
So if it's a soft landing, then rates may not come down as far because the economy is actually doing okay. If it's a soft landing, we're expecting that it is positive GDP growth. And so the Fed will have less inclination to keep dropping rates because they're going to be like, hey, listen, we orchestrated this grand slam.
If it ain't broke, don't fix it.
If it ain't broke, don't fix it. They don't want to drop them too low.
Yeah.
We might get into an environment where we were prior to this when it's too low. So a soft landing would actually probably result in less rate decreases.
Okay.
There's a million factors here, but I think you can make an argument that if you had less rate decreases, you're still going to have above average home price appreciation because any decrease will lead to home price appreciation, but it might not be as high of home price appreciation if you had more significant rate decreases. That may be it. Now, there's a million other situations out there as well. Let me play the other side, right? Recession comes. Let's say that we have at least 2 quarters of negative GDP growth. We have more unemployment than we expected. As a way to amplify the economy, what's the Fed going to do?
Lower interest rates.
Lower rates even more dramatically. What does that do to home prices?
They go up.
They go up. It's not as simple as that, though. What else happens when people lose their jobs?
They can't pay rent. They can't, like afford their mortgages, stuff like that.
Demand is also hampered as well.
Yeah.
So it's impossible to say which would be better for home price appreciation than another. You could look at it in a vacuum and say less home price decreases, maybe less spike in home price appreciation, more decrease in rates, more home price appreciation. But that's not the way we should look at this. I think the way to look at it is like, either way, you want to be in a position of strength. You want to own an asset that in a low rate environment sees a large spike in the asset value. And that's what we see in owning single family rental properties. A soft landing, though, would be more beneficial on the rental demand side, though.
Sure.
Because if you have a soft landing, less people lose their jobs. And that is a great thing for everyone. That's what we want. Specifically as rental property investors, you have less to worry about as far as rental demand going down and vacancies going up. On the recession side, there might be an argument to be made that home prices might go up more because interest rates go down more. But then you run into some more challenges about what does a recession do for our residents. Can they still afford to pay the rent? So it's something to monitor. We're going to be talking a lot about this. I think we should all be rooting for a soft landing, but I also want us to know that real estate, from both a rent perspective and a price perspective in Jacksonville, has weathered many recessions. And home prices nationally have never gone down. I'm sorry, rent prices nationally have never gone down year over year. And we have faced a number of recessions over, our economy. So don't be fearful that rents are going to go down in a recession. It largely does not happen. But overall, we're all probably going to be better off, and our common citizen is going to be better off for a soft landing. So let's root for that.
Okay, sounds good. Yeah, I mean, makes sense, man. If at the end of the day, real estate is one of these assets that is no question why most people believe that it is the best asset to have in your portfolio, right? It's surprisingly resilient. It is a critical need. We realized during COVID, right? Like how much people just absolutely need their homes and to stay in and whatnot. And I think Denny Davies puts it well here in the Q&A when he goes, Gregg and Pobs, for the current investor who really cares, as long as we are A, in it for the long term, and B, cash flow positive, shouldn't we just smile and pick up a cool drink and chill? And I would say to Denny, I love your take on that, but I would also add that it's not just real estate, but it's also this particular asset class. The idea that we're in workforce housing means that the people that live there right now, right, like this is the best place that they can afford to live for their families based on their paycheck and their current living expenses. It also happens to be where somebody who is doing a little bit better, living a little high on the hog, all of a sudden goes through a hard time. They would then go from a different asset class and then start living in our asset class, right? So the idea of workforce housing and being at this not low income housing, which people like something happens is very, very valuable, but stable, like a stable workforce that also, by the way, is the backup plan for the next level up kind of like cost of living workforce, also adds to the peace of mind of we do pretty good in this asset class, soft landing or recession.
Yeah, I love that point. This is a risk mitigated asset class, but there's 3 levels to risk mitigation, really. You start with the asset class. So single family rental properties has risk mitigation built in because it's a critical need for the individual. It's a critical need for the government to make sure that single family rental properties are working well. So risk mitigation right there. Then you can choose a market that has risk mitigation built in. And when you have population growing in a market, that is risk mitigation because people need a roof over their head. So that's built-in demand for rents and for prices. So that's your second level of risk mitigation. Your third level is the neighborhood within that market, within that asset class. And the neighborhoods that we choose are workforce housing because of what you just described there. So risk mitigation is throughout this investment. That's why we love this. That's the number one thing what clients want in this asset class. We're not out here trying to hit grand slams. We're trying to have risk mitigated, consistent asset classes that produce above average returns with really nice unlimited upside when we can get it. So you can't be in a more risk mitigated asset class than those 3 metrics.
Love it. Love it. Sounds good. Yeah, I like the idea. I like juxtaposing the idea of like a soft landing being a grand slam. But all you need is like to make contact with the ball to like succeed in in workforce housing, single family home, vertically integrated in a growing market asset class.
And I love nerding out on this stuff. I love that you guys like to be here to listen to, but don't feel like you have to know, is this going to be a recession or is this going to be a soft landing in order for you to make a wise investment decision? This is set it up well with a team and buy and hold for the long haul. It's hard to screw it up if you choose the right team and the right market and you're in for the long haul.
Love it.